Banks do not freeze money suddenly, they slow access first. Not as a warning, as a mechanism. When withdrawals take longer, when transfers stall, when approvals appear without explanation, the system is not failing. It is adjusting. Modern banking does not operate on stored cash. It operates on timing. Deposits are not assets waiting in a vault. They are claims on a system that assumes staggered access. As long as most people do not demand liquidity at the same time, the system remains stable. Stress does not begin when money disappears. It begins when behavior changes. When access demand concentrates, systems respond quietly. Banks operate under liquidity management frameworks. These frameworks prioritize flow over stock. Only a fraction of deposits exists as immediately accessible reserves. The remainder is deployed across loans, securities, and interbank settlement obligations. Liquidity is scheduled, not guaranteed. Daily withdrawal patterns are forecasted. Transfer volumes are modeled. Settlement windows are optimized. Under normal conditions, variance remains within tolerance. Tolerance is the key variable. When observed behavior exceeds tolerance bands, systems do not collapse. They recalibrate. This recalibration happens internally before it becomes visible externally. Access is not binary. It exists on a spectrum. Instant access on one end, restricted access on the other. Most users experience only the first. Under stress, banks do not jump to restriction. They introduce friction. Processing delays, manual reviews, batching instead of instant clearing. Friction spreads demand over time. Time reduces pressure. Pressure reduction stabilizes liquidity pools. This is why delays appear before freezes. It is why processing replaces denied. Why review replaces blocked. The objective is not to stop access. It is to slow it. Financial stress expresses itself statistically. Indicators include elevated withdrawal velocity, unusual transfer clustering, increased cash conversion requests, and compressed settlement timing. These indicators trigger internal thresholds. At this stage, processing times extend. Automation yields to manual review. Limits become binding. These actions are framed as operational. They are described as technical. They are labeled precautionary. The language is deliberate. Clear explanations increase awareness. Awareness increases demand. Demand accelerates stress. Opacity slows behavior. Silence is functional. Modern banks operate under layered compliance regimes. Automation flags anomalies. Flags trigger reviews. Reviews slow throughput. These systems are conservative by design. False positives are acceptable. False negatives are not. As a result, legitimate activity can experience friction without wrongdoing. From the system's perspective, this is acceptable collateral cost. From the user's perspective, it appears arbitrary. The difference lies in perspective, not intent. Slowed withdrawals do not imply insolvency. They imply liquidity prioritization. Liquidity is about timing. Solvency is about value. A solvent institution can experience liquidity stress. An insolvent one cannot resolve it. Most access controls occur in the first category. They are preventive, not reactive. Markets operate under the same logic. When volatility spikes, trading halts appear. Halts do not indicate value loss. They indicate temporary failure of price discovery. In markets, access is trading. In banking, access is withdrawal. Both are throttled to protect system integrity. Different interfaces, same architecture. Across financial cycles, the sequence repeats. First, friction, then limits, then narrative alignment. By the time official measures appear, adjustment is already complete. History does not show sudden freezes without prior slowdown. It shows gradual tightening followed by explanation. Abrupt restriction triggers panic. Panic accelerates demand. Acceleration overwhelms liquidity. Gradual friction normalizes behavior. Users adapt. Demand disperses. Pressure stabilizes. From a system perspective, gradualism is stability. Banks rarely fail without warning. They adjust first. Those adjustments appear as friction, not collapse. Slowed withdrawals are not the event. They are the signal. This is not a forecast. It is a structural observation. When access changes, structure is speaking.